So today I'm going to talk to you about depreciation as it relates to residential property, as it relates to commercial property, depreciation as it relates to things other than buildings, special rules regarding accelerating depreciation, and perhaps the most important thing I'm going to talk about is cost segregation. To begin with, residential rental property is depreciated over 27.5 years. It is straight line depreciation, which means you take your cost of the property, divide it by 27.5, and that's the amount of depreciation you can take each year. For commercial rental property, anything that is not rented to somebody as a primary residence is depreciated over 39 years. Much like the residential, you take the total cost of the property, divide it by 39, and that's how much depreciation you can take each year. Now, occasionally you're going to have assets that are not buildings. Those assets are depreciated based on something called class life. For sake of consistency, what the IRS has done is they've determined, based on the description of an item, how long the depreciable life is. Typically, equipment is 5 or 7 or 10 years, depending on the exact type of equipment. While one would think you would simply divide the cost by 5, 7, or 10 years, that's not quite the case. The IRS uses something called a Modified Accelerated Cost Recovery System, or MACRS. Generally, what that allows you to do is take a larger amount of depreciation in the first several years, and then a smaller amount in the last several years. And that allows you to recover your cost a little bit quicker. In terms of accelerating depreciation, there are several different code sections that allow you to accelerate your expensing a little bit faster than under MACRS. The first of those is Section 179. And Section 179 for 2025 allows you to expense up to $1.25 million of assets that have been purchased. Now, the caveat here is that if you purchase significantly more than $3 million of assets in total, the amount of that Section 179 accelerated deduction declines. The second limitation you have is the accelerated depreciation under 179 is also limited by the taxable income of your business. Section 179 cannot be used to cause your business to lose money. So you can bring your income down to zero, just not past zero. On top of Section 179, we have Section 168K. Section 168K is commonly referred to as bonus depreciation. Bonus depreciation for 2025 is currently 40% of the cost of the asset you place in service. Why might one use bonus depreciation instead of Section 179? Well, bonus depreciation, unlike Section 179 that can bring your income down to zero, Section 168K allows you to bring your depreciation, bring your income below zero. So typically what one would do is, if you've placed a decent amount of assets in service, is you would first use Section 179 to bring your income to zero. If there's any cost left, then you would apply Section 168K to expense an additional 40% of whatever's left and bring your income below zero. And on top of that, if there was anything left after 179 and 168K, you can apply MACRS to what's left. So the ordering is fairly important. 179 first, 168K second, and then regular depreciation third. If it's planned appropriately and correctly, you should be able to generate a very large deduction in the year that the assets are placed in service. Currently under consideration as part of the Trump Act here in 2025, President Trump has made crystal clear that he would like to bring back 100% bonus depreciation. So 168K is currently 40%, could go as high as 100% depending upon legislation. So it's fairly important to keep your eye on what's happening in Washington, D.C., because that could have a critical impact on your tax liability for 2025. Last and most importantly, we have a concept of what's called cost segregation. Typically, when we have clients come to us, they have a portfolio of rental properties. What cost segregation allows you to do is look back at the building cost And that building cost, as we've previously discussed, typically spread over 27.5 years or 39 years if it's commercial. What cost segregation does is we look at that cost typically through an engineering study, and we are able to identify a portion of that cost that is related to personal property. So shorter-lived assets, typically 5 or 7 year assets. And what that allows us to do is, instead of spreading the whole cost over 27.5 or 39 years, we're taking a good piece of it in the first 5 or 7 years. Now, what happens if you've placed an asset in service several years ago? Can you still do a cost segregation study? Well, the answer is absolutely you can. And one of the cool things about this is if you do a cost segregation study after the fact, years after placed in service, you're eligible for accelerated depreciation based on the law that was in place at the time the asset was placed in service. So as an example, if you've got $1 million property and the cost segregation study says, gee, $150,000 of that is personal property, and the property's older than 5 years, and that personal property was should have been depreciated over 5 years, well, you've got $150,000 of depreciation you didn't take. Well, when you do a cost segregation study after you've placed the assets in service, we file what's called a change of accounting with the IRS. Essentially, we're saying, IRS, we've used the wrong method of accounting, but we're going to get it right. We're going to fix it in the current year. And the beauty of this is, under Section 481A, you're permitted to catch up all the depreciation you failed to take in the prior year in the current year. So if you've got a handful of property for which you've been depreciating over a long life, cost segregation study is an essential tool in finding some very significant additional deductions. If you're somebody that needs help with this, Neil Jasani Advisors has years and years of experience. The two key things you're going to want is a tax accountant or tax attorney that understands and knows how to file a change of accounting. But part number two, the engineering study should be done by engineers. If you have a CPA firm that is going to do this cost segregation study for you and they don't have engineers on staff, you are doing yourself a big disservice. If you've got some property that's been in place for a couple years, or you've just purchased a property, please feel free to visit our website, reach out to us. We'd love to talk to you and see if there may be something we can do from depreciation or some other tax advantage strategy.